share it now.
I just hit the broadcast button. I don't know if you want to turn that off for a minute, but it's okay if we're on.
We are now on, yes.
Can you see my screen?
No, I cannot see your screen. So hey guys, thanks for everybody who's joined the presentation. We're going to get started in just a few minutes here, working out a little bit of technical difficulties, and then we'll get started. And yes, Will, I can now see your screen, and you are being broadcast. It looks like we got about 41 participants on our call right now.
Okay.
So we'll get started. Thank you for everybody who's joined. We'll get started right at the 3 p.m. time. So we got about 3 minutes. So we'll get started soon. And thank you to all of those who have joined. We'll get started right at the 3 o'clock hour. So in about 2 minutes, we'll go ahead and kick the call off. Okay, well, I have 3 o'clock on my phone, so we can go ahead and get this started. So thank you to everybody who's joined. I know there are a lot of people joining right now. We're going to go ahead and get started in the interest of time. So just want to thank Will Johnson and Haynsworth Sinkler Boyd for hosting and helping us with this webinar. As I mentioned earlier, the topic of the PPP is probably what we get the most questions on. So we're very excited and thankful to have Will talk to us today about the forgiveness process for the PPP loans. And without further ado, and not to take up any more time away from Will, I'm going to go ahead and turn it over to you.
Okay, thanks so much, Sarah, and thanks to everyone joining us today from around the state. I appreciate the opportunity to speak to you. As Sarah said, my name is Will Johnson. I'm an attorney with Haynsworth Sinkler Boyd Law Firm here in Columbia. I'm actually from Lake City and kind of half grew up in Murrells Inlet. And aside from that, I was a junior tennis player and went to pretty much every small town around the state. And then in my legal practice, I'm primarily focused on economic development, or at least I was prior to COVID. Since that time, I've spent quite a lot of energy focusing on the CARES Act, particularly the Paycheck Protection Program. But I say all that to say, in my economic development work, I've represented companies all over the state and have appeared in most of your counties in front of county councils, negotiating agreements and deals for companies that are investing or expanding in the state. And so certainly I hope that I'll be back to that, and I hope that our economic development efforts will resume in earnest when we get through this current situation. So I am going to switch over to the PowerPoint now, and I'm going to try to keep my eye on the chat feature so that I can see any questions. It will be a little bit difficult since I'm the only person presenting, and I'll kind of be focusing on the slides. So if I miss any questions, I have my contact information in a couple of places in the slides, and you're welcome to contact me afterward if you have any questions that I'm not able to address today. So Sarah, I'm going to try to switch back over to the share screen, and you can let me know if that works. Okay, do we see the PowerPoint presentation now?
Looks good.
Okay, great. So I mentioned the Q&A chat that I'll try to keep my eyes on. We'll also share a copy of the slides after today. So there's not much levity or not much that's light in the PPP world. So I figured I'd start with one moment of levity, which is there's a local celebrity, I think, on the call today. I was not expecting to get a text message from my mother last night. My mother is the lady on the left here. But third from the left is Ms. Dolores Blunt with Strand Media down in Roseland. So I wanted to say a quick hello to Ms. Dolores, and thanks for being on the call today. In the course of the discussion today, I'm going to briefly talk about the highlights of the Paycheck Protection Program. If you're on the call today, you probably already have a pretty good idea of the key components of the Paycheck Protection Program. So I won't go into detail, but I will at least give a quick overview to put the discussion in context. We'll really focus primarily on the new loan forgiveness application. The application was published Friday night. So I was telling someone, I don't know if there would have been any ideal time for that application to be posted, but I had several email exchanges with the subject line "Weekend Ruined" when the application was posted Friday night. Spent a good bit of Friday night and Saturday morning really trying to process it and understand it. It did answer a lot of questions. It didn't answer all questions. There's certainly some unclear areas still remaining. In fact, I just checked the Treasury website a couple of minutes before the call because so much information has been forthcoming that I wanted to make sure I wasn't missing anything new today. At this point, at least as of 5 minutes ago, I have not seen anything new. And so the application is what we have. I have a couple of slides here that I include just for your reference. And as I mentioned, the slides will be shared with you. So the slide that you're looking at right now includes several references from our firm's website. One is the overall COVID resources page, which includes information that we hope is helpful in a variety of areas. The second is the summary of the loan forgiveness application and instructions, a lot of which we'll be discussing today. And the third is a checklist that we created initially for lenders so that lenders can have a guide to comply with their documentation requirements. But that's probably helpful for borrowers as well, just in terms of gathering the information that's required. The next slide is additional reference points, that you probably already know how to find already, but I thought it might be helpful to have them all in one place. So these include the full text of the CARES Act itself, the forgiveness application that we're discussing today, the frequently asked questions from the Department of Treasury, and then the last link at the bottom is the Treasury website that where essentially all the new information is shared. And so if there are new frequently asked questions, if there are new interim final rules, that last link is where those items are posted. I'm checking it several times a day. And if you are on the lookout for new information, that's where you would want to go and check back frequently for updates. So I added this outline after I finished the presentation just because I thought it might help to give context to what we'll talk about. And so really there are 4 areas that we'll focus on this afternoon. The first is what are the potentially forgivable expense items? And it's important to say potentially forgivable. This is something that I've tried to stress repeatedly. When we talk about the potential forgivable expense items, we establish a maximum amount of what can be forgiven, and we then have to look at these other rules dealing with full-time equivalents and salary and hourly wage reductions in order to determine what amount of the potential forgiveness is actually forgiven. And so under the heading of the potentially forgivable expense items, we'll talk about a new rule on how the 8-week covered period is measured. We'll talk about the confusion over the requirements that expenses be both incurred and paid. We'll look at a potential new limitation on the expenses that are includable for owners of businesses. And then we'll go into items 2 and 3 are those areas where you could potentially have your maximum loan forgiveness reduced. The first is based on full-time equivalent calculations. So we'll talk through how those calculations are made. We'll talk through the safe harbor that we already knew about and some guidance on how to implement it. And then we'll discuss what looks like a new safe harbor that was in the application itself. On the salary and hourly wage issue, we'll look at the mechanics of those calculations as well as the safe harbor. And then we probably won't have time for documentation. If we do, I'll spend a few minutes on it, but I did include slides so that if you would like to look at that information, you'll have the information available to you. So the Paycheck Protection itself, as everyone knows, probably everyone on the call knows already, the highlight of the CARES Act, at least in our world, has been the Paycheck Protection Program. And that program provides forgivable loans to businesses. The intent of the program was to allow businesses to maintain payroll and keep workers employed at or near their current wage levels despite the COVID pandemic. Paycheck Protection Program funds can also be used for certain other expenses, including rent, interest, and utilities. And the main key component that made the program so attractive is the loan is forgivable, potentially up to 100%. And for the portion that's not forgivable, the loan terms are very favorable, essentially a 6-month deferral of any payments due, and then the balance amortized over 18 months, so two years in total. In terms of the focus today, we're going to talk about the new loan forgiveness application that again was posted on Friday. The application really includes 4 parts. It's an actual, the main loan forgiveness calculation form, which is supported by Schedule A. There is a Schedule A worksheet that helps a borrower complete Schedule A. And then there's an optional demographic form. Now, I mentioned there's not a lot of levity here. I will say this is a direct quote from the form. The estimated time for completing the application, including gathering data, is 180 minutes. I will be shocked if I find a lot of borrowers who spend less than 180 minutes on this form, and I would expect that that many of you will be spending quite a lot more time than that. So that's the best I can do in terms of a joke today. Apologies. So the first item that we'll talk about under forgivable expenses is what the covered period means. And the covered period is an 8-week period that prior guidance indicated would start on the date that the loan disbursement was made. So the day a PPP loan hits the account, the 8-week period was to begin, and any expenses that are eligible categories that are incurred within that 8-week period would be eligible for forgiveness. Now, the new loan forgiveness application adds an alternative period that can be used for certain items, and that's primarily payroll. The new loan forgiveness application creates a, quote, alternative payroll covered period. And so if a borrower has a biweekly or more frequent payroll, the borrower can elect to use this alternative 8-week period that starts on the first day of the first pay period after loan disbursement. And so if the loan is funded on a Monday and the borrower's pay period is a 2-week period, Monday through Friday, and you're right in the middle of it, you can elect to start your 8-week period for payroll purposes the following Monday. And so it would essentially make the calculations a lot neater. We'll talk later about whether a borrower who elects that alternative payroll period might be giving anything up. and I'll come back to that. The alternative payroll cover period applies for payroll costs as well as benefits, which include health, retirement, and unemployment tax. It also applies for purposes of measuring full-time equivalents and evaluating salary and wage reductions. Now, it is important to note that the alternative period does not apply for the non-payroll expenses. And so if a borrower elects the alternative 8-week period, the borrower would still use the 8-week period starting on the loan date for the non-payroll expenses, which include rent, utilities, and interest. Now, a major source of confusion has been and continues to be the language of the CARES Act on incurred and paid. And so as you can see on the screen, what the CARES Act provided is that the forgivable amount is equal to the sum of certain costs incurred and payments made. So I think most of us know now that those eligible expenses include payroll, mortgage interest, rent, and utility payments. There has been a lot of confusion over whether the statute means that costs must be both incurred and paid within the 8-week period, or whether it means any costs incurred plus any payments made in the 8-week period. There are challenges with either interpretation. Because if costs had to be both incurred and paid, then you could see borrowers who very appropriately incur payroll expenses toward the end of the 8-week period. But if their payroll date is not on the last day of that 8-week period, they would have costs incurred that were not yet paid. And we had even talked to some clients about trying to expedite or create a special payroll on the last day of the 8-week period to make sure that those expenses were picked up. Now, on the other hand, if it's interpreted to mean costs incurred plus payments made, then you're potentially bringing in costs beyond the 8-week period. And it does seem that Congress intended for really an 8-week period to be the measuring stick for what expenses were eligible. So the forgiveness application maybe brought some clarity, maybe added to some confusion. So I included excerpts here from several places. Right on page 1, the instructions for line 1 of the application says, enter total eligible payroll costs incurred or paid during the covered period or the alternative covered period, whichever one is relevant. If you go on to page 2, under the summary of costs eligible forgiveness, you see the first item that says borrowers are eligible for forgiveness for payroll costs paid and payroll costs incurred. That would suggest that any costs paid and any costs incurred, both categories are eligible to be included. The application goes on to say that payroll costs are considered incurred on the day the employee's pay is earned. That seems obvious, but it's helpful to see it in print. The application then goes on to say payroll costs incurred but not paid during the borrower's last pay period before the expiration of the covered period are eligible for forgiveness if paid on or before the next regular payroll date. So that was a helpful clarification in terms of some of our clients who had been thinking about expediting payroll or creating a special payroll date on the last day of the period. The application has made clear that it's not necessary to do that. If you have eligible payroll costs that have been incurred through your employees working toward the end of the 8-week period, but the last day of that period comes and it's not a payroll date, as long as you pay those employees for their time with your next regularly scheduled payroll, then those costs will be included. You see my comment in bold after, which is, if payroll costs incurred and payroll costs paid were both included, then I don't really know why it would have been necessary for Treasury to create that rule. And so that gives me a little bit of pause again. And then you see, toward the end after that, otherwise payroll costs must be paid during the covered period. So that suggests that, that payroll costs that are incurred must also be paid within the covered period, absent this one exception. So we have, a lot of confusion, particularly on the areas of bonuses and profit sharing. So let's say, that you have employees that you provide holiday bonuses to in the month of December. Can you go ahead and provide those bonuses? Let's say that you're not going to be able to use 100% of your loan amount unless you provide some additional compensation. So you might think, okay, let's move those bonuses up. So, you know, Treasury seems to be saying that any payroll costs, you know, paid during the covered period are included. But we do have that language saying that payroll costs are incurred on the day the employee's pay is earned. And so I guess while I can't give a 100% clear answer or 100% clear guidance, I think that if a company were looking to pay employees additional amounts during this time, I would really be careful about the terminology. And you know, one of the best examples I can think of maybe would be that if you paid an employee something like COVID hazard pay that's tied to the amount of time that's worked during the 8-week period or some other period included in that 8-week window, then I think you would have a much better argument that if it's necessary to make the argument that the payroll costs were actually incurred within that covered period. We've had other issues come up about profit sharing. I think a lot of companies provide profit sharing based on a prior year. And so a company may have incurred 2019 profit sharing obligations that are funded now within the 8-week period. If that's happening, I think there is a potential issue that those costs were not incurred during the 8-week period. So we get back to this confusion, and what I hope is that Treasury will be providing some further guidance to really address these specific questions that are so common. I know that Treasury and the SBA are getting these questions from a lot of folks all over the country. So I hope we'll have some additional guidance. Now, in terms of non-payroll costs, the application confirms what we already knew, that the main categories were mortgage interest, rent, and utility payments. They did add one important clarification on rent, which is they indicated that personal property is eligible. So rental obligations for personal property are included. I've heard a lot of speculation that companies that use rental cars were kind of the driving force behind getting that clarification made. But certainly based on the language of the application, with a lot of our manufacturing clients that have equipment leases, as long as those leases were in place on or before February 15th, I don't see any reason that those rental payments would not be included. In terms of the timing of non-payroll costs, the loan forgiveness application provides that non-payroll costs must be paid during the covered period or incurred during the covered period and paid on or before the next regular billing date. So that indicates that a company would be able to include costs that are paid early in the covered period, even if the bill was for service that was actually provided before the covered period started. And then on the back end, just like payroll, as long as any costs are paid in the regular course of business, they would be eligible. Now, we have gotten a number of questions about what is rent, which would seem like maybe an obvious question, but I'm not sure it is. So some of those questions have included or have focused on issues like, what if you have a lease that includes certain payments for rent, but then also includes other payments for cleaning services or maintenance fees or some other items. We don't have any clear guidance from Treasury or the SBA on that point. I suppose in the absence of any other guidance, the best advice I have would be to review the terms of the lease carefully. And if you have a stated amount of rent, even though that might include some services, I would think that unless Treasury and the SBA say otherwise, you would have a reasonable basis for including those items. If you have a lease that establishes one amount for rent and then another amount for for common area maintenance or other costs that are separately stated, then I think you might have to think more carefully about that. And I might be a little bit hesitant about including those items unless Treasury or the SBA comes along and provides a blessing for that. So I think that my ultimate takeaway is that the forgiveness application seems to really provide the best of both worlds for borrowers in terms of the timing issue, because they seem to provide for kind of a cash basis on the front end, essentially, the date that payments are made on the front end those expenses are eligible no matter when they were incurred. And on the back end, both on payroll and non-payroll expenses, they seem to have provided us the opportunity to use an accrual basis essentially, so that if the expenses are incurred, as long as they're paid in the next regular cycle, then those expenses would be included as potential forgiveness. I have a cautionary note at the bottom here, just because, as most of you probably know, the SBA has changed course many times, and so I would not be shocked if there's any change that comes again on this point. But this is sort of the best that we have right now. Now, in terms of limitations on cash compensation, what we already knew from prior guidance and from the CARES Act is that cash compensation is limited to $100,000 per employee on an annualized basis. And so that comes out to $15,385 per employee within the 8-week period. On April 24th, the Treasury Department, SBA, issued an interim final rule that provided a special set of rules for self-employed individuals who file Form 1040 Schedule C. And for those individuals, compensation was limited to, quote, owner compensation replacement, which was essentially 8 divided by 52 times the self-employed individual's 2019 net profit as reported on Schedule C, or $100,000, whichever is lower. And so we knew that that rule was in place, and for self-employed individuals under that rule, covered benefits were not eligible for forgiveness. And so your healthcare, your retirement, your unemployed, your healthcare, retirement, and unemployment tax would not be picked up as eligible forgivable expenses for self-employed individuals. The loan forgiveness application seems to be expanding these limitations. And I would have expected a significant change like this to have been set out in an interim final rule, or at least in the Treasury Department FAQs, rather than just in the instructions to a form. But you know, it's hard to predict anything right now. But what the loan forgiveness application says on Schedule A, line 9, or the instructions for Schedule A, line 9, is that you separately enter the amount of compensation paid to any owners, which include owner employees, self-employed individuals, or general partners. That amount is capped at $15,385, which is true for everyone, but the application then adds, or the 8-week equivalent of their applicable compensation in 2019. And so that is certainly beyond what the CARES Act said. It's beyond what the prior interim final rule said. I hope that we'll get some further guidance on it. But what I can say right now is the application for forgiveness includes a number of required certifications, and the language of the certification right now includes a statement that the dollar amount for which forgiveness is requested does not exceed 8 weeks worth of 2019 comp for any owner employee or self-employed individual or general partner. And they go on to remind you in the certifications that you know, you'll be thrown in jail if you submit a false certification. And so unless we get guidance otherwise, unfortunately, my best advice right now would be that for owner employees or general partners, in addition to self-employed, that we do have to look at 2019 comp and make sure that the amount that we are including in the loan forgiveness is not greater than 8/52 of that amount. Now, a related issue is that the interim final rule applicable to self-employed individuals does provide that that covered benefits for employees are not included in the forgiveness amount for self-employed individuals. So I think there is a question now about whether you know, the forgiveness amount does include covered benefits for owner employees or general partners, the same people who, you know, are subject to, apparently, to this new rule on their compensation inclusion. I would argue no, because the statement in the interim final rule came under the heading of essentially rules for self-employed individuals who file 1040 Schedule C. And so I'm not seeing that rule being extended, but unfortunately, like a lot of other things, there is certainly some gray area there. And so I would welcome any feedback, by the way, whether it's in the chat feature or by email later. I'd love to hear, what any of you are thinking on this issue or any others. I mentioned the certifications. There are quite a few. Most of them are not surprising. The forgiveness amount must be used for eligible expenses. To reiterate an important requirement that's generating some debate in Washington right now, the non-payroll costs cannot exceed 25% of the forgiveness amount. A lot of people in Congress are trying to either get that rule eliminated or perhaps change to 50%. So I would say stay tuned there, particularly if you would not be able to capture 100% of your loan amount as forgiveness because of this limitation. Do pay close attention, and it might be worth contacting elected officials to try to share the importance of that issue to you. I won't belabor the point on owner employees, but it does look like, unfortunately, the certifications are limiting what maybe could be included in cash compensation. And then the certification also provides that the borrower confirms that all required documentation has been provided to the lender. So as I mentioned, I have information on documentation at the end of the presentation today, which I hope is helpful to you. And you will have to certify that that documentation has been provided. While it's not a certification, the instructions do provide that the borrower must retain all documentation for 6 years after the loan is forgiven or repaid in full, and make documentation available to the SBA on request. So certainly keep your file on hand for that 6-year period. All right, once we've gotten through the issues of determining what our maximum potential forgiveness amount is, we then have to go through a number of tests on 2 different fronts. The first being full-time equivalent employees, and the second being salary and hourly wage levels. So first we'll talk about full-time equivalents. What the CARES Act provides is that the loan amount, that the forgiveness amount will be reduced if the employee reduces the number of full-time equivalents during the applicable 8-week period as compared to a base period. That base period is chosen by the borrower, and it can be February 15th to June 30th, 2019, or January 1st to February 29th, 2020. And furthermore, in the case of a seasonal employer, the seasonal employer can also select any 12-week period between May 1st and September 15th, 2019. I think this is one of the areas where there will be a lot of time consumed in working on these applications because employers are basically going to have to look at every payroll period within all of these applicable periods in order to determine which one makes the most sense. Borrowers obviously want to use a base period where their employment was the lowest so that they have the lowest threshold to meet in order to avoid any kind of clawback of the loan forgiveness amount. Now, thankfully, the instructions did give some guidance on what a full-time equivalent employee is. Prior to the application and instructions being released, we had no guidance on that point. And so maybe not unexpectedly, the guidance provided that a full-time equivalent is essentially defined by the number of hours an employee worked per week divided by 40, but not to exceed 1. And so, if the employee worked 30 hours a week, that employee would essentially be a full-time equivalent at the number being 0.75. If an employee worked 50 hours a week, despite working, more than the 40 hours, that employee would still count only as 1 full-time equivalent. The instructions do provide a simplified method. So each employee who works 40 hours or more per week can be assigned a full-time equivalent value of 1. And any employee who works less than 40 hours a week would be assigned a full-time equivalent value of 0.5. That simplified method, I do think, could be valuable where a borrower has a lot of employees who work less than 20 hours per week. If you have a borrower with a lot of employees who work, say, 30 to 35 hours a week, then that simplified method, could end up hurting them. At the same time, you do have to keep in mind that the same method would be applied both for the base period and the covered period. And so just because the full-time equivalent number might be higher or lower depending on what method you use, that really doesn't mean anything in the abstract unless you compare the full-time equivalent in the base period to the full-time equivalents in the covered period. So reductions in full-time equivalents will not be taken into account in certain situations. One of them we knew about from prior guidance. And in those cases, borrowers who make a good faith written offer to rehire an employee who rejects the offer will not be penalized. And so essentially, if that employee was included in the base period, but then did not come back to work, but rejected this offer for reemployment, the full-time equivalent reduction would not apply to that individual. We also have a new category, or several new categories actually, where borrowers get some protection. If an employee was fired for cause, voluntarily resigned, or voluntarily requested and received a reduction in hours, in those cases, those reductions also will not be taken into account for this purpose. So that was a very borrower-friendly clarification in the application. Now, if the rules that I just talked about would result in a reduction in the loan forgiveness amount due to a full-time equivalent reduction, there's kind of a second chance for the borrowers. And that second chance comes in the form of the full-time equivalent reduction safe harbor. And so there are two components to the safe harbor. First, the borrower must have reduced its number of full-time equivalents between February 15th and April 26th. April 26th was the date that was 30 days after the CARES Act was enacted. If there was a reduction in that time period, but the borrower eliminates that reduction no later than June the 30th of 2020, then any full-time equivalent reduction would not be applicable. And so, so that's a way that, that borrowers kind of have an opportunity to maybe, if they had reduced their workforce, but they restored their workforce on or before June the 30th, then they have an ability to, to not be penalized for this item. The application does provide that for the February 15th full-time equivalent number, borrowers use the payroll period that includes February 15th. Presumably, you would use the same thing for the other items as well. And so for April 26th, you would look at the payroll period that included April 26th. And then, you could essentially look at any payroll period on or before June the 30th. And if you have restored that number, then you would be in good shape. This actually, the safe harbor might be a lot easier for some borrowers to calculate. And one thing that I think would be a really welcome change would be for Treasury to say that if the safe harbor applies, you can skip all the calculations on full-time equivalents because it really wouldn't be necessary. I hope that that's something that we will see. I talked about the potential new rule on owner employees, general partners, and self-employed individuals. The application actually says to exclude those individuals from the Schedule A worksheet, which is where the full-time equivalent and salary and hourly wage reductions are applied. And so at least at this point, I would say that the instructions seem to imply that those individuals are not taken into account either in the base period or the covered period for this purpose. Now, we knew about the safe harbor I just talked about. We didn't know exactly how it would be calculated, but we knew it existed. One thing that jumped out at me when I first read the loan application last Friday night was what looks to be a new full-time equivalent safe harbor, because right on Schedule A at the bottom of the form provides that if you have not reduced the number of employees or average paid hours of your employees between January 1st, 2020 and the end of the covered period, note that it does not say alternative payroll covered period, end of the covered period, which would start on the loan date and end the loan disbursement date and end 8 weeks later. Then you skip lines 11 and 12, which are essentially where the full-time equivalent reductions would be taken into account. And so it does look like the application created a new safe harbor that might be an additional option for some borrowers. Now, the other area where the potential loan forgiveness could potentially be reduced is where a borrower has salary and hourly wage reductions. And the CARES Act provided that if the borrower reduces salaries or hourly wages by more than 25%, then essentially the forgiveness amount would be reduced by the excess. And so, if the applicable numbers were, $10,000 paid in the first quarter of 2020, and the relevant measurement for what was paid in the covered period was, say, $7,000, then of those amounts, the $2,500 would be within the 25% window. So that would not result in a reduction in forgiveness. The additional $500 would be the reduction in forgiveness. This reduction is not applicable to any employee who received $100,000 or more in annualized compensation in any 2019 pay period. Now that's an issue that has generated a lot of attention, because you could have a lot of employees whose overall annual pay was less than $100,000, but if they received a one-time bonus in the year, if you look at that payroll period that included the bonus and annualize it, that employee might be over $100,000. And if the employee is over $100,000 based on that calculation, then the reduction would not have any impact. And so when we're looking at this salary and hourly wage reduction, and this is something that will have to be done in preparing worksheet, the Schedule A worksheet, you'll first have to separate your employees out into Category 1, being all the employees who did receive $100,000 or more in any payroll period in 2019, and Category 2 being the employees who did not. So if there is a reduction due to salary and hourly wages being reduced, there is a safe harbor kind of tied to the same dates that are used for the full-time equivalent safe harbor. And so if the borrower reduced salaries and hourly wages between February 15th and April 26th and eliminated that reduction by June the 30th, then any salary and hourly wage reductions would not be put in place. The way that the application set up this test, it is applied on an employee by employee basis. And so the employer or the borrower employer may be able to qualify for the safe harbor for some of the employees, but not all. Now, in terms of measuring the salaries and hourly wages, for the hourly employees, we just use their hourly wages. And so that would seem to imply that even if an employee is working less hours, if the hourly wage is the same for those hourly employees, there would not be a reduction here. And that would only come into play in looking at the full-time equivalent analysis. For salaried employees, we do use the annualized salary within the first. This is true of the safe harbor and the general rule. We use the annualized salary during the first quarter of 2020, and then compare that to the annualized salary during the 8-week period. That resolved an important issue of confusion, which is that the CARES Act provided that if there was a reduction in pay during the 8-week period compared to the first quarter, which was a 13-week period, that the forgiveness amount would be reduced. And thankfully, that confusion has been eliminated by the application. So those are, I think, the main points in terms of the key items of, what are the eligible expenses that could be forgiven, how do we apply the full-time equivalent test, and how do we apply the salary hourly wage reduction. So I'm at 340. I'm not going to talk about the documentation just because in the last 5 minutes here, I want to take a look and see if there are any questions that I can go through. But I will just point you to these slides so that you can go through and see the kind of documentation that is required. You as a borrower will affirmatively have to provide this documentation and certify that you've provided it. In addition, for lenders on the call, your main obligation as a lender is going to be to ensure that this documentation is provided. And I mentioned that we've prepared a checklist, which is on our COVID resources page. It's included in the slides here. From the lender's perspective, Treasury and the SBA have been very clear that any errors in the loan forgiveness calculations are not the bank's problem. Those are the borrower's problem. But the hold harmless and indemnification language in the CARES Act that protects borrowers does require that in order to rely on that hold harmless language and on the indemnification provisions, the borrower must ensure that all the documentation is provided. And so while it seems a bit strange to say, make sure all the documentation is in place, but it's not your responsibility to check the numbers and check the calculations, I think the reality is that is what is true and what lenders need to focus on. So my contact information is there on the screen. wjohnson@hsblawfirm.com is my email address. My phone number is 803-540-7945. I'll say those one more time just in case we have people on the phone who aren't seeing the slides. My email is wjohnson, JOHNSON @hsblawfirm.com. And my telephone number is 803-540-7945. And so I'm going to look, I think I have 5 questions. I'll see if I can run through them quickly. Can PPP dollars be used to provide staff bonuses? I think that the answer is yes, with the caveat that we still have this a little confusion over this whole incurred and paid rule. And so the safest way to do it would be to ensure that the bonuses are somehow tied to work that is performed within the 8-week period. I mentioned earlier that you might provide something like a COVID hazard bonus that would be specifically applicable to this time period. If so, I think that would be the safest way to do it, unless and until Treasury and the SBA give us any additional wiggle room there. Let's see. The next question is, I'm trying to determine whether we should be using the alternative payroll covered period or just the basic period. We received our funds on April 16th. We have biweekly pay, and the first payroll day is on April 23rd for the period covering April 6th through 19th. If we use that pay period in totality, is that considered a covered period, or is it considered an alternative period? Do I need to use the pay period starting April 20th instead? I might have to reread that just to make sense of it. So whoever submitted that question, feel free to contact me afterward. But I think what I would say is that the alternative payroll cover period is going to offer a lot of convenience. The person asking this question said that their company uses biweekly pay. So if you use biweekly pay and you use the alternative payroll covered period, you're going to have a very neat 8 weeks where everything is incurred and paid within that 8-week period. Applying the measurements of full-time equivalents will be a lot easier. So that would be, I think the advantage of it. The disadvantage is that we do seem to maybe have the best of both worlds, where if you are paying payroll early in the 8-week period, even if it was for pay that was incurred prior to the start of the period, you can potentially include that pay as a forgivable expense. And then on the back end, if you have a payroll period where costs are being incurred, but they're not paid until after the 8-week period ends, you would be able to pick up at least a portion of that final payroll attributable to the pay that was earned during the 8 weeks. And so I think that for the most part, people will be evaluating convenience versus the opportunity to pick up some additional payroll and deciding which one to use. Next question is, our full-time employees work 37.5 hours per week, not 40. We calculated our FTEs on our PPP application measuring 37.5. Must we use 40 hours as our measuring stick? I think the answer is, if you do not use the simplified method, you would have to use 40 hours. But like I mentioned earlier, keep in mind that you're applying the same methodology to your base period and then to the 8-week period. And so as long as you're using the same methodology, that really shouldn't result in the borrower being penalized. The next question, and I've seen this a lot, is, when is the forgiveness paperwork due? At this point, there is no specified due date. The PPP loan application provides, the loan forgiveness form and instructions has an expiration date. And so on the top of the form, let's see if you can see it. The expiration date is October 31st. I've seen some speculation that maybe that's the best guess on when the loan forgiveness application is due. We don't have a clear answer on that. What we do know is that the lenders are required to turn around the loan forgiveness application within 60 days of receiving it from the borrower, but there's no set deadline for the borrower. And in fact, I've had somebody ask me, if you're using the payroll tax deferral from another provision of the CARES Act, once you have your loan forgiveness approved, you can no longer take advantage of the payroll tax deferral. And so I have had at least one person, maybe a couple, ask, can we push back the date that we submit for forgiveness so that we can use that payroll tax deferral longer? I'm not seeing any limitation on that right now. So we'll see if a deadline is added. Next question is, does the full-time equivalent have the 25% reduction threshold? The answer to that is no. There's no kind of wiggle room within the full-time equivalent calculations, only the safe harbors. If an employee is terminated, do they count as a 100% reduction in wages as well as a reduction in full-time equivalents? I'll have to think about that one and get back to you. Whoever asked that question, send me an email and let me think about that. I think the intent was if employees are terminated for cause, I think the idea would be, that they are, that would not penalize the borrower. So I think that would be intended to apply across the board, but I'll have to think about that a little further and would be happy to talk about it offline. I think some of these other questions are more specific. So I think what I'm going to do is wrap up there. But for anyone, if I haven't answered your questions or if you have any others, please feel free to contact me by email or phone. I'd be happy to hear from you. If I said something that you disagree with, or if you have any other good ideas that I didn't share, I'd love to hear those ideas as well. We're certainly all learning together in this process. So thank you again for all of your time today. I appreciate this. I hope this was helpful to you, and I look forward to hopefully hearing from many of you soon. With that, Sarah, I will turn it back over to you.
Thanks, Will. Well, thank you everybody who joined us today. I saw the questions that asking whether or not the slides will be sent out. Yes, the slides will be sent out to those who registered for this webinar, and we also will have a recording of this that we can send out, and I believe we'll probably highlight that in one of our daily 3 emails or one of our top 3 emails that we send out a few times a week at some point. So thank you again for joining, and Will, thank you so much. We love getting to have webinars with you and other lawyers at Haynsworth, Sinkler, Boyd, and getting to work with you. And we look forward to working with you in the future.
Thank you, Sarah. Have a good afternoon, everyone.